Good morning, everybody, and welcome to this webinar, which is co-hosted by BDB Pitmans and Goodman Jones. Preparing to succeed in 2021 is a very big subject. It raises a lot of commercial, legal and tax questions around the areas of workforce, workplace, structure, commercial relationships and change. Today we will seek to address many of the questions you have already put to us. If the presentation prompts further questions for you, please use the Q&A function, which you'll see at the bottom panel of the screen. And I'll try to deal with them later if there's time. If we don't manage to cover everything in this session, please don't hesitate to contact us directly. We should say that this event is being recorded and will be available afterwards. Both firms will issue a follow-up email to all those who registered with key takeaways, a copy of the recording, and contact details for all the panelists and their expertise. Mindful of your time, we will finish at 10:30, so let's get straight into the questions. So the first question we have is, have staff gained new employment rights during the pandemic? I'd like to hand over to Brian for that.
Well, thanks, Larry. Morning, everybody. Well, the answer to that is no, but staff think they have. And also, employees are using old rights, existing rights, differently to try and get different things. So I think employers do need to second guess all this. The main ones to watch, I think, number one is working patterns and flexible working rights. We've got a few questions on detail on that in a minute, so I'll leave that for now. There's secondly, the whole thing about furlough. It's not as simple as everyone thought it was going to be. And people are saying they've got a right to go on furlough, which is not true. They've got to be a right to be brought back from redundancy to go on furlough, and new furlough now. Again, that's not true. The next one I think is health and safety. You have not looked after my health and my safety in the office or in the way I travel to work, that sort of thing. The next one's important. It's the whole concept, I think, of selection, being selected for a change, for a pay cut, for an hour's cut, for furlough or for redundancy. Employers need a proper business case to do any of these things and a proper consultation procedure. And COVID doesn't select it for you. People seem to think this. And we're seeing a lot of, I'm only being selected now because I've been on furlough before. So that's quite dangerous. And the final one, I think, is whistleblowing. This is the concept of an employee saying, I told you were doing something wrong. You've treated me badly because I raised it. And it's wrapped up in all sorts of things, but particularly health and safety, not complying with guidelines. You haven't done your tax affairs right, and things like that. And it's a form of discrimination now, and it's uncapped. So I think, Larry, some dangerous claims out there. Need to second guess them. Business cases are needed to avoid getting backed into a corner, really.
Thanks, Brian. And another question for you, Brian, is are all staff entitled to work flexibly now?
Well, that's another no, Larry.
Okay.
I mean, the flexible, there's a lot about flexible work. Flexible work's about hours, it's about part-time, but a lot of it at the moment is about place of work. A lot of the focus on home working or office working, and quite a lot of misconceptions flying around, I think. Lots of employees are saying, I've proven to you that I can work at home. So I've got a right to work at home, and I'm going to go and work in Wales, and think they can do that. I think everyone needs to bear in mind that it's the employer's choice, this. And people forget the old style, well, they still exist, but we haven't seen them operated for a while, flexible working requests. If you'd asked a while ago to work 2 days a week at home, that's a massive request. And this will return. And of course, all wrapped up in lots of other areas like childcare, maternity, illness, caring for others. But as I say, it is a business choice, and businesses need to assess their workforce properly in sections and sectors. You know, what do you need to, well, who do you need to work in the office and why? And you can do that assessment now, but you will have to do it again once COVID's all over, because there's no doubt a new way of thinking, but still a business choice.
I think that leads neatly into the next question as well, which for you and for Richard. And now the staff are working remotely. What are the issues? And of course, in the new normal, whenever that arrives, working remotely is going to be a big issue as well, isn't it? So do you want to?
Larry, there's like a couple of points I would like to just cover off here, because I'm coming at this from a tax point of view, and that is that employment taxes are based very much on not so much where the business is, but where your employees are and where they're physically carrying out their duties. And whilst that's it's easy to determine when you've got them, you can see them, they're in your office or they're in your retail space or factory or wherever. When they're at the end of an internet connection, they literally could be anywhere in the world. And do you know where that is? Because if they're not in the UK, is that going to cause you any problems with legislation elsewhere? And even in the UK now, of course, we've got devolved tax rates, so they could be paying different rates of tax depending on where they just happen to have decided they want to set up their internet connection. And you need to be on top of that and aware of where they are. The other issue is not so much a tax one, it's more of a practical one, and I guess ultimately the markets will determine this. But it's no secret that pay rates vary dramatically from place to place in the country. And is that still appropriate? Are sort of larger salaries in the central cities still justified when staff are actually not going into those cities? I say that's a question, I guess, for each employer and their employees to decide. And I don't know, Brian, have you got anything to add to that point?
Yeah, we've seen a lot of this rumbling, Richard, at the moment about reducing salaries because you don't need to travel or you no longer work in a particular place, in London in particular. But it'll come down to a consent issue. People will have to get, if they're going to effect change, they will have to get consent, or at least backed by a good business case to make these changes. And I think coming back to what you said earlier, Larry, it's going to be very important for employers to be clear on what they're talking about here. The place of work or your base is really, really important. I think most businesses at the moment are still, certainly professional type of business or office-based businesses, they're still working on people who are temporarily at home, but their full-time contractual office base is still in existence. It's a wholly different thing to transfer yourself to people who are permanently at home, because that is health and safety. There's a whole health and safety difference. It's really quite a different thing. I think we had another couple of questions, Larry, which are coming up, which I'll probably deal with here, which is about the need to change contracts at this time with flexible, with your workplace. And one of the attendees has asked, if I've got people working 60% of their time at home, do I have to change their contracts? Well, I think you just need to look and see what you're trying to achieve. It is possible to say that you've got an office base, but you're flexible to be at home for 60% of the time. You're still office based. So people need to look at those issues.
So that's still a temporary workplace, a temporary arrangement, so to speak, if they're working from home.
Yeah, it can be. The business has to decide what you're doing there.
Yeah.
And there's lots of other issues about flexible working. I mean, face to face, I think there's a hidden time bomb there about the damage the business will face. Yeah. People are not face to face.
One of the really interesting things is that if a job can be done working remotely on a permanent basis, then that job can just as easily be moved from Hertfordshire to India or China or anywhere in the world.
Yeah.
There's no need to go to an office. So there's a risk there for certain types of employment situations. Another question here. I have some staff who have chosen to work from a different jurisdiction. What would this mean going forward? Richard, would you like to take that first?
Yeah, certainly. Well, again, from the tax perspective, if you're working in a different country, what are your obligations there? And I want to really emphasize here that there's a difference between the tax liability of the individual and that the obligations of the employer. And most countries have a rule where you'll be tax resident in that country if you're there for broadly more than half the year, and that's a fairly sort of general rule. Obviously, there's nuances from country to country, but and also the double taxation agreements tend to support that by allowing countries to continue to tax their own nationals or their own residents whilst they're working temporarily in the other country. But that's for the individual. When you're looking at your obligation as employer, it can be quite different. And if you take, for example, in the UK, the first instance is if someone comes to work from you, it doesn't matter where they've come from, and they start working, on day one, you've got an obligation to operate PAYE on their salary. Now, there are various schemes in place in the UK that help out for internationally mobile employees, which will ease that burden. But they will have to be set up and agreed with Hmrc in advance. So really the message here is if you're going to allow staff to work in different jurisdictions, you've got to really be on top of what your obligations are there, because they could start immediately with you having to set up payrolls in other countries, for example. And the other point I want to raise here is that what's the effect on the rest of the business of having staff working elsewhere? Is there a danger that you may actually end up setting up a permanent establishment in another country simply because you've got a couple of staff who are on their laptops in their holiday villas in Spain or wherever? I don't know if Graham wants to pick this up later, but I just want to raise that now. There is a possibility that the staff working elsewhere can have a fairly major impact on your tax obligations, not just for employees, but for the business as a whole.
Brian, do you want to pick up there?
Yeah, thanks, Dave. Just a couple of points. I mean, the way the question's phrased is interesting because staff have chosen to work from a different jurisdiction. Staff can't choose where they want to work. So again, the employer needs to grab control of these things and also be very clear what you're doing. So there's quite a difference if you're keeping someone as a UK employee, but you're seconding them out to one of your businesses abroad, or you are posting them out. That's quite different to moving their workplace abroad.
And Graham, do you want to comment on the structuring issues there?
Yeah, thanks. So Richard used the expression of permanent establishment. The concern is that if you have people who have a long-term base overseas, then a footprint of the British business is actually physically located overseas, and therefore there are profits generated outside the borders of the United Kingdom. And of course, it's no surprise around the world that many governments try and tax as much as possible on the profits generated within their borders. And therefore there is the possibility that having that person work overseas for a long period of time actually generates profits overseas. And therefore, not only do you have the payroll obligations that Richard alluded to, but also there's the risk that you suddenly start looking at profits taxes and maybe sales taxes being payable overseas. It's uncertainty, and one of the things we're finding is that organizations who acknowledge their staff are now outside the UK are sort of saying, well, is there a way that we can ring fence and sort of be a bit more certain about the obligations that we're entering into in another country? And the really simple way around that, and the popular way around, really due to commercial risk mitigation, is actually setting up a company in that country and populating that company by the individuals who are working there, and therefore you're sort of identifying who is in a country, what they're doing, and what economic profits they're generating, which gives you a bit more of an understanding of obligations. And if you do then find that you have people who are overseas, the question, which is allied to the city centre observation made previously, is different salary rates are applicable in different countries. And if someone is going to a lower level of salary jurisdiction, is it fair that they still get paid maybe central London wages? And maybe there should be some sort of salary equalisation mechanism so that economically they are getting the correct amount of pay for the economy they're sitting in, rather than the British economy.
Yeah, I think that's a key issue, and I think in the new normal we'll see quite a lot of jobs moving around the world. Next question was, what can I do to look after key staff when cash flow is so uncertain? Graham, do you want to pick up there on share incentives and so on?
Yeah, I mean that you've taken the words out of my mouth. Cash is king, and employees are key. If you are finding that the remuneration package has to be flexed, either because incomes to the business are lower, or actually you've identified those key individuals and you can't pay them more, but you want to ensure that you maintain them and incentivize them, then share option planning is always the top of the pick list. In the UK, we have a number of Hmrc approved share option schemes. Approved means they come with some form of special tax break, with enterprise management incentive, or EMI as it's quite often referred to, being what I consider the gold star of share option planning. It's an arrangement that allows a great amount of flexibility as to who it applies to, the terms that the options are issued under, and the time period in which the options can exist. Also, they can be what is colloquially known as exit only, which means that the options only are exercisable the millisecond before the business has grown. And psychologically, that has been proven to have senior management a real incentive to grow a family business or a private business, to allow it to be sold, because then they participate in the sale. Now, all tax breaks come with some restrictions, and the common restriction for the approved tax breaks, especially EMI, is that it's really for trading businesses only. And sometimes, especially in the family business setting, you'll find that what started off with generation one being a trading business may have morphed into something that is a bit trading and a bit investment. So as monies were generated, they were reinvested in the business, maybe in property or something else. And therefore, quite often we find, as part of the share option planning, there is a restructuring that separates the trading side of the business, i.e. the bit you're really wanting to incentivize management on, from maybe the property ownership side of the business. That allows management to focus on the things that are under their control, i.e. the trading activities. And also, I've heard it said, and it's actually true, that it allows the business owners to be ensure that management don't participate in maybe any uplift in property prices, which are outside their direct control, and management are therefore solely incentivized by trading activities.
Great, Graham, thank you for that. If I move on to the next grouping, which we've got a heading of workplace. Our first question there is, why do I have to continue paying rent and service charge for a building that I can't use? As you can imagine, everybody, that's a pretty popular question at the moment. So can I hand over to Jonathan to deal with that, please?
Thank you, Larry, and good morning, everybody. Yes, it is. I mean, it sounds a bit like a question you'd get from an insolent teenager with slouched shoulders, but it's been a very pertinent and frequent question, certainly over the last 6 months. Because you can see, a lease is essentially a contract with some guarantee of income on one side and guarantee of occupation on the other. And the occupation side has fallen away due to restrictions. So tenants have found themselves stuck with financial liability for empty buildings. And the first thing to say is it's generally accepted that this doesn't fall into a category of frustration, which would basically destroy the lease. It also doesn't fall into the remit of insurance, which would trigger a rent cessor, which would mean that you didn't have to pay the rent, which leaves it open for intervention. And the intervention from the government through the Coronavirus Act really just kicked the can down the road. What it essentially did was to impose a moratorium on taking action against tenants, most fundamentally forfeiting a lease, which in the current climate is the last thing a landlord would want to do. You want to keep the tenant alive, you want to keep that income stream and that debt going. So it really left the debate about rent payments to the parties, and it's been a bit of a horse trade. I mean, the market has responded quite well, I think. Landlords have had to sit up and listen. I think it's been a sea change generally in the relationship between landlord and tenant, because in the past, the tenant did his thing, landlord regarded them as a sort of distant cash cow. Suddenly they're talking, and the landlord is having to understand the tenant's underlying business, their accounts, their income, because there's had to be a conversation about justifying some sort of concession around rent. As of March, when this first hit, the argument was a bit of a difficult one, because generally institutional leases have rents payable on a quarter day and they're payable in advance. And if you think about the first main lockdown, that happened just before the March quarter day. So most tenants would already have had that cash ready. You know, the pandemic hadn't bitten in terms of an economic impact on their business. It got worse in June, but even between March and June, there was a discussion between landlords and institutional landlords. Some of the big players did take the view that they would meet tenant demands and honour some sort of rent concession or rent holiday. There was then a whole range of ways to do that, and that ranged from a complete holiday of 3 months' rent, postponing the rent and adding it onto the end of the lease by way of a reversion release, because the landlord then had an additional term and wasn't giving away value, postponing the rent and adding it to subsequent rent payments over the next year. So you're basically rolling it up, but you're only just, what you're really doing is, you know, pushing the problem down the road, or some other exchange for value. So taking out a break clause in return for some rent free. So there was a general debate about that. And I think the market did respond relatively sensibly, and it did lead to a far greater understanding between landlords and tenants. To answer the question directly, you do need to pay rent because that's a debt that is due. Most leases will include no set-off clauses. There is nothing that kicks in terms of frustration or rent cessor, so it continues to be a debt. Service charge is a little bit different. There remains an obligation to pay it, but of course, service charge isn't a rental payment. It's a reimbursement of costs incurred. Some of those costs will be constant, insurance, certain upkeep of the building. Some of them will fall away with the lack of occupation of the building. So I think tenants facing service charge demands that haven't changed should be scrutinizing them, because there must be an element of reduction of cost given what we've been through.
Thank you for that, Jonathan. Next question, so for Jonathan and for Graham. My property requirement has changed, but I have an ongoing lease. What are my exit routes? So you want to pick up with that first, Jonathan?
Yes, certainly. I mean, that question tends to follow the first question pretty rapidly once I answer the first question. So there are essentially three ways out of a lease. I think the first thing you have to do is get rid of this idea that a lease can just be dispensed with and the parties can walk away. You know, the lease continues. It is an ongoing debt and an ongoing commitment for the lease term. So your routes out typically are assigning the lease, which is basically selling on the lease. Selling might not be the right term, because the chances are if you've got a rack rented lease, you won't get a premium for that. But assigning the other lease and getting somebody else to step into your shoes, and you fall out of the picture, save for the fact that you might be required to, you probably will be required to enter into an authorized guarantee agreement should the next tenant default. The next possibility is an underletting. And most leases will permit underletting on certain terms, usually that they will be at the market rent at the time. And of course, you have to find somebody willing to take on the premises. The slight downside with that is that as between you and the landlord, you stay in the contractual picture. So you are still directly liable to the landlord. You just have a subtenant below you that mitigates your cost. Now, it may be that you can mitigate part of that cost by underletting part of the premises, but your lease would have to permit that. Many leases only permit an underletting of whole, because if you start chopping up premises, it creates a bit of a management problem, not least if one of the tenants goes, if you were to go bust and the landlord is left with somebody occupying just part of the building. So that's those are the sort of contractual ways to mitigate your liability or indeed exit the lease. The other one outside of the terms of the lease is a negotiated surrender, which we've seen a lot of people agree with their landlord. Obviously, that depends upon the prevailing economy, and at the moment, it's difficult for a landlord to see an active demand from tenants to step in where their current tenant can't perform. So what you'll tend to see is a reverse premium paid by the tenant to pay down some of the rental liability that it would have had for a portion of the term. And that will be mitigated because there's if you have 3 years left on the term, there is a general assumption that the landlord will be able to make good with another tenant within that period. So it's a sliding scale of negotiation. And I think Graham was going to say something about the tax treatment of those premiums that I so casually refer to without getting at the tax side.
Thanks. Yeah, the first thing I'd say is what I'm talking about is English landlord. Scotland may be slightly different. The first thing that one has to understand is the length of the lease from a tax perspective, because there are different rules for leases of more than 50 years compared to leases of less than 50 years. They just fall in different areas of the tax legislation. If we looked at the three alternatives, the assignment or the sale, there's some very specific tax legislation that allows you to predetermine what the tax liability would be if you sold the lease, likely to be within some sort of capital gain, and therefore you receive money in, you pay some tax on it. Underletting is really just, as Jonathan says, it's an offset arrangement, and you'd like to think that on an annual basis your outgoing rent is X and it's offset by income of Y, so effectively your net cost to yourself is less, and you get tax relief on that net cost. From an accounting perspective, there's a slightly interesting point, and I'm probably not the best person to talk about this, but if you have, say, a 10-year lease and you've got £1,000 of liability and you've got £500 coming in, is there some sort of loss that you can recognize from an accounting perspective about the future of the lease? I guess that would be more relevant if you were really making a loss on it because you couldn't recover all your outgoings, because certainly for trading companies, if you can start recognizing losses, and assuming your accounts will allow it, you might get some sort of early tax relief. And the surrender is probably the most interesting from a tax practitioner's perspective, because when one advises a client, assuming the client is the tenant, one needs to understand how the landlord would be taxed, as well as how the tenant will get relief. And that's part of the commercial negotiation, understanding the tax profile of both parties. Because, as I say, if a lease is less than 50 years, you're into different rules from greater than 50 years, and therefore the tax profiles of the various parties can actually be quite different. And just my final observation on the sublet, I have seen an instance where a sublet was agreed, but it was actually a sublet to a landlord, and that was all geared up in this principle that you might be able to get accelerated tax relief if your accounts allow you to start recognizing future losses on leases.
Thanks, Graham. I've got another question for Jonathan here. I still need an office, but how can I future-proof my business given the changing requirements for staff and occupation?
Yes, thank you, Larry. And I think this turns slightly to the the topic of this session about preparing to succeed, because with every challenge there is an opportunity. And what we've seen is that the bargaining position of tenant vis-a-vis landlord has strengthened. The landlord's position has softened, and they are having to take on positions that would have been unheard of previously. So if you're a tenant who is willing to commit to new space or an extended term, there really is a bit more of a menu in terms of what you can ask for now. I think in terms of flexibility, we've touched upon the idea of being able to mitigate your liability through underlettings or assignment. You should be looking at those provisions to try to get maximum flexibility. So if your building can sensibly, or if your floors in a building can sensibly split into parts, then first of all, try to take those in separate leases of parts. If you have a lease of 3 floors, why keep it all in one lease? put them into separate leases, because then you have an ability to deal with those constituent parts on a more flexible basis. Assignment and underletting, you should be scrutinizing those to ensure that they are flexible, making sure that underlettings can occur at market rent rather than the headline rent under the lease. Maximum flexibility in terms of a test of covenant strength for incoming tenant. Just think about those exit routes in the future, should you need them. I say there's a lot more flexibility in that landlords have had to sit up and listen in order to retain their tenants. I mean, this is probably most obvious in the retail space, because they have been at the coalface of the difficulties here. And in the retail space, we have seen institutional landlords accept what we were sort of calling a COVID clause, which is to say there has been the sort of shutdown that prevents us from undertaking economic business at the property. Here's our notice, we are now triggering a rent cessor. Now that's pretty punchy if you think that behind all of these landlords tend to sit institutional funds, and behind those institutional funds tend to sit lots of our pensions. So commercial property has always been a one-way bet in terms of certainty of income, upwards only rent reviews, but I think we are getting to a point where that sacred cow may be slaughtered, if that's not too dramatic a way to put it, because there's been a debate about upwards only rent reviews for some time. Certainly outside of this country, people see them as very onerous, but landlords have always stuck by those. The other question is about the calculation of your rent. So what's always been fixed rent in retail circles is now commonly turning to turnover rent, which is a situation whereby the landlord will get a minimum payment that he knows he can bank on, but the rest of it is based on a tenant's turnover, a percentage of turnover, which again leads into this idea that landlords have to take a far greater interest in their tenant business and understand management accounts and income. Now you can see that in the retail space, because that has been decimated. I mean, I think there's a statistic that says that in England from June 19 to June 20, we've lost something like 5,300 retail units, which have just gone. So landlords have to take a sort of softer position with retail tenants, just in terms of keeping their buildings open, because remember, it's not just the rental income that the landlords stand to lose, they also pick up the rates liability once the building has been void for a while. So you do have a decent hand to play as a tenant that needs space and is willing to commit, and I think you should use that to your advantage. The other example is more generous rent-free periods. If you're taking a long-term lease and you know that your business is going to need the premises, the chances are you can negotiate a far longer rent-free period at the moment. So throughout the old rule book, because landlords have to take a much more pragmatic and cooperative approach these days.
Thank you for that, Jonathan. I've got a final question under this section. I own the building. What can I do to protect myself from falling demand? Would you like to kick off with this one, Graham?
Yeah, thanks. We're seeing a bit of this, and what we're noticing is that there seems to be a bit of an uptick in commercial to residential development. Now, I'm sure Jonathan will have lots of views on the ability to get planning and things like that, but let's just assume that all of those boxes are ticked. Then really the two considerations are direct tax and VAT. VAT is obviously a turnover tax, and there are different rates of VAT that apply to different parts of development, and therefore your VAT planning is key. From a direct tax perspective, really it depends on what the residential development is like to be used for. If it is used for rental income, then there's a different profile from residential development to sell, and we're finding that certainly there is an appetite for residential development to sell. I talked previously under the EMI about there are subtleties in the tax world between an investment business and a trading business, and certainly residential development to sell is a trading business, and therefore families can start looking at maybe some of the trading tax reliefs if they're doing residential development for sale.
Thanks for that. Jonathan, do you want to pick up anything there?
Yes, certainly. I mean, we've seen trends towards office buildings being sold for permitted development, usually on the back of a prospect of permitted development rather than the owner actually progressing that itself, because conversion from commercial use to residential use is a tough job, and one left to the experts, to be honest. So most people establish that there is that ability and then sell on that basis. I think before you get to a conversion to residential, which is a fairly fundamental change, it's worth noting that the planning system has freed up recently considerably with the new introduction of Class E, which is not a recreational drug. It is a change to the planning system where we used to have very structured use classes for different uses, split across commercial uses, retail, office, storage, all those different classes, and they were very specific, and both the planning and leases were geared towards those specific uses. Class E basically wraps up most commercial uses under one use class, which means that if you had a falling demand, say for office in an area, there is a lot more flexibility in the planning system to pursue another commercial use. Things like gyms and all sorts of things now fall within the same use class. And there was a great pushback on that. It actually went to judicial review because the idea was there hadn't been sufficient consultation. This was a major change in the planning system, but that judicial review has been recently kicked out. So that is open. In terms of the planning position on changes from commercial to residential, that was effectively a change from office or retail into residential. There is a consultation live now about extending that permitted development right to the entirety of Class E, and that's running through January, I think. So that might well open up a lot more possibility in terms of conversion outside of those strict parameters. What I would say is that with every helpful rule, there's usually an unhelpful exception, and in valuable areas, major local authorities in London, they have sort of disapplied that permitted development right by use of what's called an Article 4 direction. So they take away that permitted development right. So before you look at that, you'd obviously get a planner involved and look at what the position was with your local council, just to see that the permitted development right had survived.
Thank you, Jonathan. Thank you, Graham, for that.
Thank you.
We move on to our third section, which is structuring for 2021. And our first question for us to deal with there is, can we service our debt over the next 9 months? And could you pick up on that, Alexander?
Yeah, sure. I'd be delighted to. Thank you very much. Good morning, everyone. It's a well-put question. Can we... Servicing debts, what we've noticed is that all companies, for very good reasons, a lot of businesses have taken on a lot more debt over the COVID period. For very good reason, they've got to keep themselves going. They will have been through processes already of checking whether they can afford to do so or should have done. But they would have done that several months ago. I think coming into the new year is a very good time to refocus on that question. So this is a very pertinent question to raise, because with the very emotional need to keep your business going, it is very attractive to take on lots of new debt, but you have to keep on top of your ability to repay that. 9 months in this question actually is a good time target to focus on. It's neither too short a time period to think easily that you can get through it, nor is it too far away to think that the world might change in a way that you can't enunciate well. So 9 months is a good time period to focus on. What it means is if you're going to service debt, you've got to put together some medium-term forecasts, include long-term liabilities, which are going to have to be paid at some point, and they never go. Long-term ones never go away. But also with some short-term cash flow, just to make sure you can get through the next few months, and then the mid-term forecast will show whether you can get through to the 6 to 9 months, and then the longer term after that. If you put all those together, that will, of course, give you a good idea as to what you can do. The question, the answer to all of this, sort of, can you service your debts, is never a yes/no binary answer. In current circumstances, it's an even grayer area than is normally the case. But that may seem very disadvantageous to many, but actually can be used to your advantage. Everyone is pretty much in the same boat. There's a collective problem in our economy, but that can be a positive. So, whatever your position is, when you look to see whether you can service your debt, there are means to improve it. So simply, whether it's a positive matter, I think the better question is, can you service your debt better? This leads on to questions that have already ideas of incentivizing people working within your business that have already been touched on. But if you can service your debt better, then you're going to be in a better place. If you are finding it difficult to service debts, there are ways and means of putting yourself in a better position. Various processes, formal or informal, can be gone through. But I think the most important point here is to re-emphasize that everyone is in more or less the same boat. So what you need to do is speak to all of your stakeholders. As has been touched on before, even various stakeholder classes such as landlords, sacred cows, whilst not being slaughtered, are finding that they are having to be brought down. They're not as sacred as they used to be before. So as I say, speak to your stakeholders, all of them, landlords, lenders, the main ones. You can either, using the information you've already put together with your medium-term forecasts and your cash flow forecasts, go to your lenders to see if you can extend terms, see if you can change the covenants. It is a very good time. There are a lot of lenders out there who are wanting to lend and extend terms. There's a lot of political pressure on banks to do so. So you can seek new lenders or add different types of lenders, asset-based lenders who do cash flow lending. Hmrc is also a key stakeholder who you can speak to. They are used to having to help businesses carry on trading. The only note I would put in there is that there are, in line with Hmrc's new ranking as within, if anything goes wrong within the insolvency framework, is that there are potentially more stringent liabilities on directors for carrying on trading whilst Hmrc debts are outstanding. That's not to scare people too much, but just to make sure that Hmrc are kept very much in the conversation so that it makes it harder for them to complain later on if things don't go as they expect. One of the other main parts to look at is your supply chain. Stretch creditors, be generous to your debtors if they pay early. They may pay early on a discount. Think about shared resourcing. Go to some of your creditors, some of your suppliers, see if there's a way of sharing the business that you make together. And last of all, but very importantly, go to your shareholders and your equity. Again, there is quite a lot of liquidity out there that wants to be invested. Your shareholders may have access to that, and that is a good way of getting some cash into investment cash into the business in the short term. But the main point is that with talking to your key stakeholders in particular, make sure they understand your business. The more they understand what you need to do, where your pressure points are, the more they are actually going to be cooperative. I keep returning to the general point is that most people are in the same position in that we are all have pressures put upon us by this COVID over 2020, and looking to 2021, everybody wants to be able to come out of this in a better state.
Yeah. Could I, if I could move on to another question, Alexander, please, and that is, what can I do to protect the strong parts of the business? And I think if, Graham, do you want to pick up initially on that, on demergers and the like? So what can I do to protect the strong parts of the business?
Yeah, thanks, Larry. Yes, in the UK we have a number of mechanisms that allow for tax efficient breakups of businesses. And the theory being, of course, if you have a strong part and a weak part, you don't necessarily want the weak part to bring down the whole, and therefore you can separate out the various parts. Let's just pretend that you've got a business owned by A and B, and it's got two different divisions, Division 1 and Division 2. These techniques allow you to either separate out so that A and B both own Division A and both own Division B, or even separate out in a way that A can take, say, Division 1 and B take Division 2. And that allows for different skill sets to take the different divisions forward into the future, and therefore hopefully allow the businesses to remain both strong in the longer term. Really, there's two mechanisms one uses. One is either uses a part of the Insolvency Act that allows a new company to be liquidated as a process in separating out the stronger parts and the weaker part of the business, or one can use the Companies Act and a capital reduction, which is another mechanism. Really, the difference between the two is the former, the liquidation requires more steps, it requires different steps. The use of the Companies Act really is more reliant on accounting and corporate law and paperwork rather than physical transactions.
Thanks, Graham. Is there anything you want to add there, Alexander?
Yeah, just to emphasise that where you are leaving sort of the less strong parts of your business apart from the stronger parts, you need to be careful that you do still leave those weaker parts of the business in a viable trading position. If that is under any sort of risk, you need to take very specific professional advice on how to deal with that. There are various hardening periods for how long businesses have to carry on trading before they get into financial difficulty without impacting the previous transaction that put them separated them. The one thing I would prioritize though is try and take a positive proactive stance where you're separating parts of your business. The less strong parts, see if you can divest them proactively beforehand, seek positive acquisitions of them rather than looking to deal with them after the destruction.
Okay, excellent. Thank you for that. Thank you, Graham. Our next question is, we are considering an exit for 21-22. What are the key areas we should consider? Hollie, do you want to pick up on that one?
Thank you. Well, we'd always start by recommending that you undertake due diligence on the business and look at it through the eyes of the buyer to spot potential weaknesses. And by due diligence, I mean reviewing commercial agreements and questioning, are all the key customer supplier agreements in writing? Are they enforced? Are you too reliant perhaps on one customer? Is a contract renewal coming up which will coincide with the potential exit? And does the sale in fact trigger the contract to terminate? And query, what would the impact be on the buyer of that? For many organisations as well, one of their biggest assets is going to be intellectual property. So really considering, have we adequately protected our IP rights and our brand? And that process applies equally to employees and property aspects of a business too. Are they up to date? Are they all in order? Thinking about that question a little wider and thinking about it from the perspective of within the business itself, are all the shareholders on board with the sale in the time frame you have in mind? Do you need to consider as a business any potential succession issues prior to the sale? And finally, just to think about, it's an obvious point, but the sale price is going to be fundamental. So when thinking about a potential exit, you can't start work too early on working with your advisors to consider who the potential buyer will be. Are they going to be a competitor? Will it just go out to a trade sale? And what kind of valuation are you considering? How will the business be valued? Is it going to be a reasonable valuation, bearing in mind the last 12 to 24 months may not really accurately represent the business because of the impact COVID's had on it?
Thank you, Hollie. Another question we have in this same section is now the right time to hand the business down to the next generation? Graham, do you want to cover that?
Yeah, thanks. Hollie was talking about third party exit. And of course, actually handing the business down to the next generation is a sort of internal family exit. There's a reasonable piece of analysis that says if you look at owners managed businessmen, they are less likely to have a pension pot than an employee. And the psychology is that they have always seen the business as their pension pot. And therefore, it's very unusual for an individual to give away their pension. So why would an individual give away their business? And the answer becomes, what is the business here? Because it is possible that you could have a situation where the family business, let's say it's in manufacturing, and it owns the freehold of the factory. Or going back to the demerger point, the stronger parts of the business, it might have divisions A and B. And therefore, it's quite possible to do some pre-gifting structuring that allows the current generation to keep some of the business. And using my manufacturing example, that generation may keep the factory and therefore generate rental income into the future that is their new pension rather than the totality of the business. So certainly it's quite possible to gift to the next generation on a very tax efficient basis, but I think the gifting generation just need to sort of forecast not into the medium term, but actually into the very long term and say, if I am no longer involved in the way that I am today, what will I be living off in the future? The question was actually, is it the right time? And certainly we are finding that we are having more and more discussions with our client base on that very point about how do I structure it, because the family are feeling that this is the right time. It might be the right time because they feel that COVID requires new challenges. I mean, look at the professional services sector. None of us were working from home on Zoom. We all are now, and so there's been challenges for industries, and they're different challenges for different industries. And maybe there is a generation that says, I just don't want to spend too much of my time and energy reinventing myself in a new business environment. So it's the right time in that respect. In terms of valuations, they may feel that property values are low or business values are low, and therefore if there is some sort of tax risk because they have the wrong sort of business, or there's some inherent gain that they have rolled over into a business that will now fall into charge, maybe it's the right time from a tax perspective. Certainly gifting can be done tax efficiently. Whether it's the right time really becomes a decision for the family, and every family is different in that regard.
Thanks, Graham. Got a Brexit question here. I thought I was prepared for Brexit, but given the remaining uncertainty, is there anything more I can do to ensure that I can continue to trade with EU markets with minimum disruption? Graham, do you want to pick that one up?
Yeah, thanks. I mean, that is a very specific question, isn't it? We're 20 odd days to the 31st of December, and certainly if I understand it correctly, Boris Johnson's in Brussels again today, or will be tomorrow, trying to continue the negotiations. I mean, if that's not definition of 11th hour, I don't know what is. The only certainty we have is that we don't know how this is going to play out, and therefore what should be happening, and it doesn't matter whether you're an exporter of goods or services, is actually look at the countries to which you are trading or with which you are trading, and actually understand primarily your VAT consequences of doing business with that country, because at a worst case you might find that there is an obligation to register for VAT in each of those jurisdictions, and there are plenty of EU jurisdictions that you might have to register. And you might say, well, hold on, that's just an administrative point, and it is an administrative point, but if you're trading in, I don't know, 15 different EU states and you're having to register in 15 EU different states, maybe each with their own language, that might be a different skill set that you need for your staff. You might be outsourcing that to advisors in that country, and therefore it comes with a professional overhead. So really, for me, it's sales tax is the key one. Allied with tail tax is obviously import duties that you might have to pay at the new EU border, and an EORI number, the number that allows the smooth passage of goods out of the UK is an important one to ensure that you have.
Thank you, Graham. I'm just conscious of time. I'm going to skip to the next section, which is commercial relationships. And I have a question there, which is COVID has made some of my commercial relationships simply impossible. What can I do? And Hollie, if you can pick that one up.
Yes, thank you. We've seen a lot of our clients reevaluate their commercial contracts because of an inability to perform them themselves, or because they have insufficient client demand themselves for the goods or services they're purchasing, and or just a general dissatisfaction with existing terms they've signed previously because of the effect of COVID. So we're advising clients, review the terms of your contracts, really understand if there's a mechanism within the contract to address the problem. Can you terminate for convenience, for example? Is there a force majeure clause, which I'd say tread very carefully with the force majeure clauses, because we've seen a variety of standards of those clauses. And this exercise has really helped clients to get to know where they stand before approaching their counterparty. It's interesting that we've seen clients who aren't seeking to end contracts, but actually they simply want to renegotiate existing terms which were pre-COVID negotiated, and we're seeing a sort of a trend that they are being successful in achieving a variation to those contracts with more favourable terms, because really the counterparty wants to achieve a long-term relationship. So I would say, if you don't ask, you don't get, and I definitely recommend that understand what your contractual terms are and do approach your counterparty. And I know Richard is seeing this approach on the regulatory side too.
Do you want to pick up on that, Richard?
Yeah, just unmuting myself. Yeah, thanks, Hollie. Really, I'm sort of picking up on a point that Alexander made earlier, is that no matter what you think about paying tax, I'd encourage you to think of HMRC as part of your commercial relationships. And on a personal note, I've found that throughout the sort of COVID period, talking to HMRC, but actually trying to get through on occasion it's difficult, but once you actually do, you find you're talking to people who are sitting in their own homes, and that actually seems to make things slightly easier talking to them. And the revenue have actually done pretty well in looking after what they would describe as their customers, and agreeing terms for payments over a fairly long term. So yes, get on the phone. Don't wait to the last minute. Don't allow the collector coming banging on your door. And if you do manage to negotiate a good terms for payment, make sure you stick to that, because they have very sort of rigid rules. If you miss a payment, they'll suddenly come back to you and say, no, let's have the whole lot now. But if you talk to them before that payment comes due, it's much easier to negotiate either a delay in that or a slightly different term. So yeah, have that dialogue. Don't be afraid to speak to the revenue about your tax obligations, and let them know early if you're getting into trouble and want to negotiate terms.
Thanks, Richard. And the last couple of minutes, we'll just finish off with positive change. And the question we have there is, how do you affect positive change? And Brian, can you deal with that, please?
Yeah, thanks, Larry. It's quite a big question, but I think John picked this up earlier on. There's challenges, but there's opportunities around at the moment, and certainly from a workforce viewpoint, dealing with people, I think employers have a big scope to change things. Staff, for the most part, staff get this, that they get that there's business issues, and if you're transparent with them and gain their trust, you can do pretty much anything you like. But you must start with a business case, which I mentioned earlier on. Really analyze it, the commercial side, your legal side, your tax side, and get that structured in and present it to staff and present it to people. And it cuts through everything and all the challenges that might come up with it. I think without it, you can get distrust, and in a sporting analogy, you kind of lose the dressing room. But with it, people are involved. You can do things. So I'd encourage people to take that those opportunities.
Thanks, Brian. Well, just a few seconds left. I think it remains for me to thank the panel for all their contributions, and thank you, the audience, for your time. If this raises any questions that you'd like to discuss, please don't hesitate to get in touch with any of us. As I said earlier, we'll be circulating contact details for all the panelists. And finally, I'd just like to wish you all a healthy, happy, and successful new year. So thank you, and that's the end of the webinar. Thank you.